In this week's video, we will look at risk management in the context of 2008 and discuss how it applies to the 2014 stock market. We've got a lot to cover, so we'll be moving directly to the charts. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We'll briefly be looking at two charts of 2008, and then we'll move to 2014. This is a daily chart of the S&P 500, 2008 here, 2009 here. If you're relatively new to investing, this can be fairly intimidating, trying to answer the question, how would I have managed through this 50+% decline? One of the ways that we can do it, and there's many ways to approach the market, is instead of trying to predict when we're here what's going to happen over the next 12 months, or worrying about where we'll be when we're here, where we'll be here, it's better to use somewhat of a divide and conquer strategy. This is the war, it's the bear market. What we can do to make sure that it's not overwhelming is we fight small battles, and typically all the battles are relatively similar. This is what an uptrend looks like, this is what consolidation looks like, and this is what a downtrend looks like. The key to fighting small battles is staying in the now and worrying about what's going to happen in the intermediate term from a probabilistic perspective. So when we're here, our focus is in here. It's not way out here. When we're here, our focus is inside this box. We're going to be in an uptrend until we're not. As long as we're in an uptrend, we leave it alone. When something changes, then we fight another short-term battle until something changes. How does all this apply to the present day? This is the present day chart of the S&P 500 as of the close on Friday, August 15th. Remember, there are three primary battles that we can fight. What type of battle are we in now? This is an uptrend battle here, marked by a series of higher highs and higher lows. That's what an uptrend looks like. We really don't have a downtrend on this chart. To get a downtrend, we need a lower low, a lower high, and then a lower low. We don't have that yet, so we're still fighting somewhat of an indecisive battle. We fought this battle here. Now we've got a new battle, but we don't know what type of battle it is. From here, typically one of three things can happen. We can go on and make a series of higher highs and higher lows, and then we're fighting an uptrend battle. We can consolidate within this range here, which is an indecisive battle where we try to be patient and minimize our chess moves. Or the stock market could be rejected here and go down here and make a lower low below this low, and then we're fighting a downtrend battle. So where we are now, we're still in, we're not sure exactly what type of battle we're fighting. Since that's the case, we try to remain patient and trade less rather than more frequently. Here you can see on Friday, we had mentioned 1958 as a guidepost. We closed below it on Friday. We have not cleared that. We closed at 1955. We talked about the 50-day moving average at 1957. We closed below that as well. A week ago, we were patient due to the potential support. Support held, but again, we don't know what type of battle we're fighting. We want to fight in compartmentalized small pieces. So how can we do that going into Monday's session or going into next week? As human beings, what we want to know is, where will we be in 6 weeks or 3 months? Will we be up or will we be down? But the battle we need to fight is to stay in the now. So if we're concerned about missing a 100-point rally on the S&P 500, then we know this. It's not possible to rally 100 points for several weeks or several months without first taking out Friday's intraday high of 1964. This is an indecisive look here. It might even be a hanging man, which is a potential reversal pattern from a candlestick perspective. This is our upper wick. This is our lower wick. We also know that if we're tossing and turning at night and we're worried about a multiple month correction that could last 120 days possibly and see prices fall 10% plus, if that's what we're worried about, we also know that that can't happen until Friday's intraday low of 1941 is taken out. So to compartmentalize our battle next week from our perspective and under our system and for our time frame, we would prefer to sit tight until the market at a minimum clears 1964. We'd prefer to see it on a closing basis. If we do, then we're more likely to incrementally move some cash into equities. Conversely, if we go to 1941, we wouldn't necessarily make a negative or bearish chess move there. If that's the case, if we take out 1941, we might consider adding some bonds based upon the evidence we have in hand now. We already own some bonds, and they did well for us again this week. If we go below 1941, we should defer back to the previous chart. If we take out Friday's low of 1941 here, we still won't know what type of battle we're fighting. In fact, the way we'll treat it is we're fighting a range-bound battle between, let's say, 1958-ish and 1904-ish. So as long as we remain between 1958 and 1904, all things being equal, we'd prefer to make fewer moves or no moves. Why? Because if we can exceed 1958, we will be making our next chess move with better information. Or if we come down here and make a lower low below 1904, we will also be making our next chess move with better information. This, if we break 1904, now we have a low, a lower high, and that would be a lower low. That's a downtrend. The odds of a correction would be greatly diminished if the S&P 500 can go on to make a new high here above 1990. We'll enter next week with a flexible, unbiased, and open mind. Since we still have an indecisive and unclear mission here, we don't know what battle we're fighting, the charts are mixed, so we're going to go through them quickly because price is the best way to manage in the short term and compartmentalize. This is as of the close on Friday, August 15th, S&P 500 weekly. We would prefer to see the present day morph into our full bore bullish look with price above both moving averages, blue above red, and the slopes up. We have a tweener look. It's an in-between look. It looks better than it did last week, but it's still not a full bore bullish look. If this morphs into this, the probability of good things happening will increase, especially if it looks like this as of the close next Friday. We also have potential resistance on this chart here around 1970-ish, 1965-ish. This was support. It may act as resistance, 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 may act as resistance. This line here could act as support. So we're fighting a range-bound battle until proven otherwise. Moving along with the mixed bag theme, NASDAQ weekly has converted back to a full bore bullish look. It also exceeded this trend line here. These are all forms of observable improvement, and they did check bullish boxes in the CCM market model. We're just trying to give clients and regular viewers a feel for what we're seeing. We'll move through this quickly. The NYSE Composite Index, basically the exact same story that we just told about the S&P 500. Few quick points on the weekly chart of the Dow. First of all, if you're frustrated in these markets, well, it's been a little difficult. Last week, the Dow hit a point here the exact same point that it hit in December. It's made no progress, a lot of volatility. Bad news, still has not converted into any type of bullish look. Good news, mixed bag. Resistance, breakout, support, acted as support again. So a mixed bag here with some good and some bad. How is it possible that the market model is still hovering around a 50-50 type look? Well, this is the credit markets, and we know that JNK and TLT have a maturity mismatch. We're well aware of that. This has a full bore bearish look. This is checking very few bullish boxes. Another example of a somewhat confused market. This is small caps. Here's a point here in October of last year. We roughly came back to that point last week. This, like the previous charts, a mixed bag. It appears to be holding at potential support, but it has not converted into a full bore bullish look. This is a consolidation look for the most part. Would I rather own small caps or treasuries from a weekly trend perspective? The answer is still treasuries. This has a full bore bearish look against small caps relative to treasuries or TLT. We prefer to see this chart from a bullish perspective in the equity markets morph into something like this. This is the S&P 500 risk on relative to the VIX Fear Index risk off. You can see the ratio was rejected here. Stocks were weak. This is the S&P 500. Rejected at resistance. Stocks were weak. Broke out. Stocks did well. Here we are testing resistance again. If we can morph into a look like this and get up here, that's bullish for stocks. If we get rejected like this, it increases the probability of bad things happening to equities in the short run. Another example of risk on versus risk off showing indecisiveness. This is stocks versus long-term treasuries. It's telling us to be careful. This is part of the 50% negative in the market model. This ratio has gone nowhere in 10 months. October 2013, exact same spot today. This is what indecisiveness looks like. For comparison purposes, this is what 10 months of bearish conviction looks like in 2008 in favor of treasuries. And this is what 10 months of bullish conviction looks like favoring stocks over bonds. The bad news is this is difficult or more difficult to manage through. The good news is the longer we consolidate, typically, once we break out, the bigger the move up or down that we typically get. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currency, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.